Welcome to the Arbitration World podcast, in which we focus on significant developments and issues impacting international arbitration. We hope you enjoy this discussion. Please do get in touch with us if you have any questions about this week's episode or any areas you would like us to cover in a future podcast in this series.
Welcome to another in our series of podcasts on cases, developments, and issues in international commercial and investment arbitration. This podcast is the second in our mini-series exploring some of the issues that arise out of the third-party funding of claims, something that's increasingly common these days as the funding sector continues its rapid growth, particularly in the area of international arbitration. This presentation is limited in scope as appropriate for a general audience and applicable time constraints. This presentation is not offered as legal advice, which should be obtained only from properly licensed legal professionals on the basis of the specific facts of a given case. All speakers appear in their personal capacities, and any opinions or views offered are those of the speaker alone and do not necessarily reflect the opinions or views of Kernel Gates LLP, Longford Capital LLC, or any other entity or individual. I'm joined today by John Garda, the Managing Director of Longford Capital. As many of you will know, Longford is a leading player in litigation funding with offices in Dallas and Chicago. It was founded back in 2012, which is some time ago in the world of litigation funding, which is obviously a new sector, relatively so. And it's raised around $1 billion to support claims. In addition to supporting international commercial and investment arbitration, it also invests in really any type of commercial dispute, including breach of contract and business fraud claims, antitrust claims, IP claims, which usually consist of patent infringement, and bankruptcy and insolvency-related claims. John is a former partner of Kernel Gates and has been active in the funding sector for a number of years and with Longford since 2019. Well, thanks for agreeing to participate, John.
Thanks for having me, and I really appreciate you welcoming me to the program. And, Longford is a good example of how the litigation funding industry has grown in the last 15 years or so. The first fund that Longford had was in 2014, and that was for $56 million. The second fund in 2017, 3 years later, was $500 million. And the third fund that we closed about a year ago is $682 million. So it gives you a good path of the explosion of the industry, in particular in the United States, which is where we're operating in. And so our company kind of reflects that growth.
Yeah, I mean, it's interesting to speculate what size your next funding round will be if you've gone up at that kind of exponential rate. Well, let's dive into it, John. I mean, we all know that there have been issues over the degree to which privilege applies as between a funded party, its counsel, and a funder. And I just wanted to start by asking you, how do you seek to approach the privilege issue?
Yeah, so right off the bat, we make it clear that we don't want any attorney-client privilege information. We don't need it. We specifically ask not to receive it. So that's point number one. When it comes to work product, especially in the States, there's very strong case law that keeps developing that work product isn't discoverable. So that's good and gives comfort to the law firms and the clients to share information. But there are still sensitivities along the way. And so we hold a lot of video conferences. We could share a lot of information just as we're doing right now in the podcast through video conferences. And we could get around any sensitive item with respect to getting to receive what we need to evaluate without putting the law firm or client in an uncomfortable situation for what they're providing.
Thanks, John. I mean, one of the things you hear whenever people discuss the funding sector is it takes far too long to close the deal. In your experience, how can a law firm and its client shorten the time it takes to get to, indicative terms, so before you get into final phase due diligence?
Yeah, that's and that really does vary from one opportunity to another. We try to meet the client and the law firm's time deadlines, whether they're internal or external. And we do receive opportunities from before a case is even filed to cases on appeal. And so a lot of times before the case is filed is when you have a time crunch. And the law firm and the client want the funding in place before the case is filed. So what I would recommend, especially to law firms, is we like to see an opportunity fully baked right? It's fully developed from the law firm's perspective. And kind of like, what does that mean? Well, a good way to think about it is if the law firm was going to take it on a full contingency, the law firm and the lawyers running the case, they know what they need to see and develop to get it approved by the law firm's, management committee for approving those types of deals. And so that's the information that we'd like to see on the front end already developed. And the more that is developed, the quicker we can act. And we will act and work tirelessly to meet those deadlines as long as the information's provided that way. And we've approved cases as early as like 1 week from the time it was presented to, we've had other cases that there weren't time deadlines and it's extended months, if not over a year or so before it finally got funded.
You mentioned contingency cases for where law firms are taking it. What's your attitude to funding a case where the law firm itself is on a contingency? Do you like to essentially share risk with a firm that's already sharing risk itself, or would you prefer to be the only party that's in there taking a success fee?
Well, with the law firm sharing right off the bat, it gives us confidence that the law firm believes in it. Typically, we want to see the law firm have skin in the game, provide a significant discount off the fee portion. We're always going to fund 100% of the costs, but do the discount off the fee portion for a healthy success fee. We like that. That's an alignment of interests. But a lot of times now we're funding opportunities based on just paying the claim owner a monetization of the claim because the law firm's already in on a full contingency. The arrangement's fine between the client, claim owner, and the law firm. So we're paying the claim owner a portion of the total value of the case. And we like that because, again, the law firm's believing in it so much they did it on a full contingency.
Sort of sits quite nicely with my next question or next topic. I mean, there's a lot of talk in the sector and within the legal community of portfolio finance. What are your own thoughts about portfolio finance, and maybe define what you mean by portfolio and share your thoughts on when they might be good ideas to structure that way, when Longford likes them, or when you prefer to deal directly with the claim owner. I know different cases, different approaches may be suitable.
Yeah, right off the bat, from a statistical standpoint, our portfolio as a whole for the company is right around 70% are cases funded directly with claim owners, and 30% are, law firm portfolios. That's kind of the ratio. Portfolios, what it means is that we're funding a group of cases, whether it's a group of cases that the law firm's handling for different companies and clients, or it's a group of cases that the claim owner, the company itself, has that they're pursuing in a sort of a campaign of cases. My personal view is the preference is to do as many funded cases directly with the claim owners. Simply, right off the bat, it's because the pie to share is bigger. Because if you're doing an arrangement with the law firm, then the funder's only sharing that contingent fee portion that the law firm is getting, which is, 40% typically in a full contingency fee case. If you're doing it with the client, you have the bigger piece of the pie, up to 100% if the law firm's not even having a success fee. So that's a big reason why I prefer to have as many cases funded directly with the claim owners. But because of our relationships with so many law firms out there, an arrangement that's starting to develop more and more is, I call it an informal law firm portfolio, which means we're funding a lot of cases for that the law firm's handling for different clients, but we're doing the deals directly with the clients. And some of the benefits of doing a law firm portfolio are like cross-collateralization. And what does that mean?
But that's in relation to your investment. So if you fund one that doesn't work out well, you can claw that back from a later successful one. Is that what you mean, John?
That's exactly it. But we get comfort in sort of security of returns based on volume of cases that we fund anyway. And with our rate of success, if we're funding 10 cases that a law firm's handling and they're deals directly with the client, That's good diversification. That's going to give us a lot of security for having a good return as a whole for the 10. So the need for cross-collateralization, in my mind, is lessened because of that. But the more we can develop relationships with law firms where they're presenting several cases for different clients and we do the deals directly with the clients is certainly my preferred way to go.
I mean, I know you're a large player now. You mentioned something about the volume of capital now invested in claims. We hear a lot about ethical investment structures. How far are you constrained by those within your investment community? Do they put markers down on when they're investing into your fund of types of claim that they don't want to invest in, which means you then you have difficulties in taking those individual claims, or can you segment and get around those difficulties?
It's interesting. So from an investment investor profile, we're virtually all U.S.-based investors for the most part, which is amazing. We've been able to get through it with that much capital raised thus far. But that has kept things more simple because it's all U.S.-based for several reasons. So we've been fortunate where we're not restrained from types of cases to fund or not to fund, other than it needs to be commercial context, really. Our investors don't want to be investing in pure personal injury related cases. And we know that. And so we manage that. But our investment committee always has an eye towards our investors when we're deciding what cases to fund. And, a simple threshold question is, if it gets out that we're funding this case, would we be proud of it? Would there be any embarrassment to it? We're constantly keeping that in mind. We do stay away from cases that have a political bent to it. We just don't get into that at all. A couple of subject matter restrictions. We typically don't fund cases against law firms because they're a great source of opportunities for us. So those are business decisions and judgments we make, but we're not restrained for the most part by our investors.
And are you finding that you are making more of your investments public now, investments into cases? There's obviously a move towards the disclosure in my world, in international arbitration, of the fact of funding and indeed often the name of the funder. Do you find that you have now out in the public that a lot of the cases that you're funding, or are many of them confidential?
Many, and really the large majority, are still confidential. But as the years go by, that may change, right? And international arbitration is a good example of disclosure. There are likewise courts in different jurisdictions that are coming up with their own rules that are kind of mirroring what's getting disclosed in international arbitration. We have always sort of embraced the disclosure when it comes to, identity is fine. The identity, whether a case is being funded and the identity of the funder, no harm, no foul kind of thing. When you get into deal terms, that's where we would give a lot of pushback.
Terms of the funding arrangement.
Yes.
Yeah, I mean, I think so far that tends to be being kept confidential, I think, pretty much across the board. Can I just move to a subject that I don't hear other people talking about when discussing funding? So I thought it might be useful to raise with you, the concept of the secondary funding market. Do you at Longford invest into claims ostensibly being backed by other funders? And do you seek to offload some or all of your own risk via the secondary market? And if yes, what drives a decision to bring somebody else into your deals?
So the secondary market is continuing to develop more and more. There's reasons for that, and we can get into those reasons. So basically, the answers to your question are yes. And here's how some of it plays out. So first of all, the secondary market is a great development in our industry because it helps provide some liquidity to the industry where the subject matter isn't very liquid, right? We're sort of dependent on when the case gets resolved to receive our proceeds and returns. But with a secondary market, to be able to recoup proceeds before a case gets finalized is a great thing for us and for our investors. Where we're looking to get into it more and more is based on life cycle of our funds. They typically have a 8-year life cycle. So when a fund is coming up to the end of its life cycle, to have a secondary market to turn to is a great vehicle. So that's area number one. Area number two is we get presented with some humongous opportunities in terms of dollar amounts with campaigns and other kind of things. So concentration risk could be an issue, both on a subject matter or just pure total dollars.
Sort of 25 million and up, or even bigger than that?
Bigger. So, like, let's take our third fund at $682 million. If we have an opportunity for $100 million or more type of investment in the same vehicle, whether that's one huge situation or a lot of cases that make up that vehicle, concentration risk is just something you have to be mindful of. And we may bring in co-investors to the deal, but our first approach would be as a benefit to our investors, who are a lot of institutional investors for the most part. And to give that benefit to them, first, they want to get more and more involved in the industry. They're investing with us already, but to give them additional opportunities that way is very well appreciated. And it's just further relationship building.
Well, thanks very much, John, for your time today. Very much appreciate you speaking with us on these, I think, interesting topics. Thank you very much indeed.
And, Longford's been a long-term client of K&L Gates, and the firm has done a wonderful job representing us. So we really appreciate being a legal partner with the firm.
Thanks very much, John. All the best.
All right. All the best. Cheers.
Thank you for listening to this episode of Arbitration World Podcast. To listen to past episodes and receive notices for new episodes, subscribe by searching Hub Talks, that's HUB Talks, in your favorite podcast app. We hope you will join us next time for further discussions on hot topics and significant developments in international arbitration from around the globe.